All right, guys, welcome to a brand new episode of Philosophy Culture. Back again with the broadcasting. What's up?
What's up, big bro MS? How you doing, bruh? Bruh.
Good. Yeah, bro. I'm good, bro. Yeah.
Awesome, bruh.
And yeah, bro. And this episode is gonna be about the house market crash, bro. Yeah, which happened in 2007 and also called the Great Recession. And it has like another name as well. But yeah, we're gonna talk about that and what more casting.
I mean, we'll just go into some brief details, some general details about the crisis, right? And
Yeah.
try to explain it as good as possible, hopefully. Uh, so yeah, check it out, man.
Check it out. All right.
So the standard question, the classic question, the the kickoff question. Why do we choose to talk about this topic, Emmett?
Uh, well, it's pretty big crisis that happened, and yeah, it's important to know about this stuff, as we have said in all the previous episodes.
Yeah,
Yeah,
exactly.
and it was pretty recent, even though time goes super fast, and it's now a while back, but it still kind of feels recent in a way. So yeah, it's good to find out what really happened.
Yeah.
Yeah. What about you?
Well, I kind of agree. I agree with you. And I don't know. I read on in some sources or in some articles that the Great Recession could have been much more devastating than what it actually was, even though it had like a huge impact on the economies and so on. But I mean, after the Great Depression, the Great Recession was the second biggest financial crisis. Uh, so yeah,
Wait, is this?
this is the second biggest financial crisis
Yeah.
according to the sources.
All right, but like, is this called the Great Recession,
Yes,
the Great Depression, the Great Recession? Okay,
yes. The Great Depression was in 19 there. Come on, we talked about
29,
in the
20.
nineteen
Yeah,
hundreds. Yeah,
yeah.
and the Great Recession, which we will talk about today, happened between 2007 2009,
Yeah, yeah, yeah.
approximately.
Right.
Yeah.
Okay, let's get into this. What happened?
What happened? The dot-com bubble and 9/11 happened in the beginning of it all, kind of. If we start from the beginning, uh,
Panini, yes.
beginning. Okay, no, but I mean, so the dot-com bubble, it basically it happened in the beginning of the 2000s, approximately, in the
Yeah,
end of 1990s, uh,
yeah.
which also was a huge financial crisis. I think we have covered this during another episode.
Yes,
Uh,
sir.
and besides that, we also had 9/11 during the two. This happened during 2000,
2001.
2001, yeah.
Yeah.
Which obviously had a huge impact on the US economy with a lot of, you know, insecurities and so on. So the Fed chose to lower the interest rates, right, to stimulate the economy and put more money into, yeah, just put more money into movement. Just make sure that everyone starts, borrowing and lending and so on from each other and from financial institutions. And yeah, it kind of worked. Uh,
Indeed.
kind of. And would you like to take it from here, or shall I continue? Or I don't know how to divide this, like split it up.
I don't know, man. You did such a great job, so I don't. But all right, yeah. Well, they stimulated the economy with lowering the interest rates, which resulted then in the early 2000 housing boom, right? In the house market, since mm, as you said, they wanted people uh, to loan a bunch of money or like just to get more loans out to the people, if
Yeah,
that is the right formation. Uh, which then resulted in, well, yeah, more people buying houses, and which resulted in them uh, lending money from the banks, and which resulted in a bunch of mortgages, which they uh, were burdened with afterwards. And maybe you are better at explaining this part, but the investment banks saw this as an investment opportunity, right? Since they could, how is it? They could buy the mortgages from the banks, right? And when they bought mortgages, they bought like loads of mortgages at once, which resulted in this, I don't know, a pool of mortgages, and then they sold parts of that pool to other investors. Am I
yeah,
right?
yeah,
Which was like shares of the pool, right? And kind of that is where the whole, uh, I would say, the whole bubble started to, uh, yeah, where it got its beginning.
yeah, exactly. So since it got so cheap to actually take out the mortgage, and since
Yeah,
everyone could afford to take out to just take a mortgage from the bank and
yeah,
buy a house, the demand increased very much for the housing market, right? For houses. So they start building, building, and building, and that also increased the overall prices for other, for construction materials, and yes, just general things that you need to build a house and so on, right? So there were other markets that boomed besides the housing market, I believe.
right,
Um, and with increasing demand, the prices are also increasing. And as you said, uh, that led to the housing market being overpriced eventually. Um,
all right. But I think I don't know. From my perspective, when the investors, saw that they could sell off mortgages and like create all these financial systems and like use other financial instruments to benefit off of the housing boom. That is where the greed took over, and I would like to say that this is where also the subprime mortgages come in the picture, or
mm,
would you say otherwise?
yeah, I would say that the subprime mortgages, like I think they came into the picture like in the beginning of the whole thing with the lower interest rates.
Right.
No. Or yeah, I don't know, maybe I'm wrong. But it felt like they did everything, or not everything they could, but they did very much to, make it affordable for everyone to just take that mortgage and buy a house. So
Yeah, yeah, yeah. Because
uh,
I think it's good to keep in mind the idea of greed as a as an underlying, or as a almost as a foundation for the bubble, and the subprime mortgages come into the picture when yeah, they wanted to have even more mortgages to sell off, right? To sell off to the other investors, which would result in more money being in motion, I guess, in the housing market. And the subprime mortgages was um, well, I'm no expert, but it feels like it was the one of the first mistakes they did when they allowed the subprime mortgages to be so easily given out to people.
Mm.
Since yeah, since the subprime mortgages are basically mortgages. What is the right terminology to say? But like given out or allowed to people who uh damn, what was their
That had a lower credit score,
credit
or
score? Thank you.
yeah.
Yeah, yeah. So yeah,
Yeah, and there were like different kind of red flags with those subprime mortgages, right? Like the adjusted rates. I
yeah,
mean, most of them had like an adjusted rate, so they were like, so the mortgage had a rate which was based on a threshold which varied based on the interest rate that
right.
the Fed somehow. I mean, it wasn't directly, or yeah, it was kind of. How should I explain this? But I mean, as soon as the Federal
Hmm.
Reserve changed the interest rate, that would obviously impact this adjusted rate for the mortgages as well.
Right.
So it wasn't like a fixed one where you would pay, I don't know, let's say 1% or something.
Exactly.
Um,
Which then resulted in a bunch of people getting the subprime mortgages. They got their home, and then later on, when the economy got a bit more stable, or when it became time to increase the interest rates, their mortgage became much more expensive. Or yeah, maybe that's not the right wording, but the mortgage became they couldn't afford to pay the mortgage any longer since the uh yeah. Well, it basically got more expensive to pay off the house.
exactly.
Yeah,
And that's when everyone starts selling, right?
yeah,
And this sort of bubble burst since the demand uh, the demand fell, of course, and the supply increased, so the prices fell as well. Um,
the what type of supply and demand are you talking about? Are you talking about the houses which were like
yeah, the demand decreased, sort of, right? Because no one wanted a house anymore
right?
because it was just expensive to have that kind of mortgage, and yeah, everything just got too expensive. And
Exactly.
the supply of houses, so the houses on the market increased, right? Because everyone was selling.
Yeah,
Uh, and if they weren't selling, the bank would just have taken their house, right? Because
yeah,
you're when you're kind of backing your mortgage with your house.
yeah,
Uh, but again, the issue there was that the housing prices were just decreasing. So the actual loan, so the asset that the loan was backed by did also decrease.
right.
So it was this gap that was like completely messed up. Um,
Which
um,
then resulted in the financial institutions in
mm,
also getting hurt by that as well, right? Since they can't. So if the let's say I think they were betting pretty hard on this idea of if the person can't afford the mortgage, they would default on the mortgage, which would then grant them the house, right? Or uh, give them the house.
Yeah.
And it didn't really work out that way.
Nope.
So
Exactly. And that's why also, I mean, you mentioned earlier about these um, mortgage-backed securities, right? That's what you explained with the whole selling mortgages and then putting them all together and selling pieces of them to just investors.
yeah,
And it seemed, for first it seemed like a super safe bet, right? Just because I mean it's real estate and the prices are just increasing. It's like the most stable thing you could invest in. Uh, and that's why so many people started to investing actually in mortgage-based MBS, I think they are called. MBS, mortgage-based
yeah,
securities, MBS, because
yeah,
they were like more secure than bonds and the stocks and so on.
right.
Uh, and then the bubble burst, and it seemed like they weren't as secured as they thought they would be, since the prices fell and the mortgages actually became very, very undervalued, right?
Yeah,
Uh, or maybe you should call them value to their actual price because everything was already overvalued during this bubble. So everything just sort of came down to their initial price, and they obviously made some. There were many firms and investors that yeah, lost a lot of money on that.
yeah,
Um,
exactly. Mm, yeah. Then also it kind of goes hand in hand with the subprime mortgages and the kind of the the whole system which allowed for these more relaxed loans, to people, and yeah, which is the lax relaxed regulations or the loosened regulations, which were also a thing that took place and kind of goes hand in hand. I don't want to talk in circles, but yeah. um, so which then allowed for more risky lending practices and excessive borrowing. Yeah. Are you frozen? Ah, dang it, man. But all right. I think we can maybe do a summarization and see if Costin comes back. But I would just go through quickly the causes and the small summarization I got from ChatGPT. And then the number one cause was subprime mortgages, or number one, like it's just with the first number. So banks and mortgage lenders issued a large number of subprime mortgages to borrowers with poor credit histories, lending to a high risk of default. And then we have the housing bubble. Rapidly rising home prices created a house bubble fueled by speculative buying and easy credit. I'm just going through the kind of the bullet points I got from ChatGPT to kind of summarize the whole event. Then maybe we can speak a little about maybe I don't know if we can correlate this event with the other financial bubbles we have talked about earlier.
sure. I was frozen for a couple of minutes, so
Yeah, yeah, yeah. That is exactly why I started to kind of
good,
yeah.
good.
So it's all good, but all right. So yeah, number two was housing bubble. Number three is a securitization. Mortgages were bundled into mortgage-backed securities (MBS) and sold to investors. This spread the risk of default across the financial system. Number four is what I was mentioning was these lax regulations, insufficient overnight and regulation allowed risky lending practices and excessive borrowing. Number five is credit rating agencies overestimated the safety of the mortgage-backed securities, giving high ratings to risky investments, which they actually were mentioning in the videos, right? They were giving these investments a triple A rating, right? Which I think kind of symbolizes that it is a pretty safe investment, if I'm not wrong. Or am I?
No, I think you're right. I'm actually a bit unsure about that, but let's see.
I'm not sure as well, but I think it's along the right lines at least.
Yeah, the highest possible rating that the bond may achieve is AAA rating.
Right. And then under this whole event, we have the key events. Yeah. Which is the rising defaults. As home prices began to fall in 2006, many homeowners, especially those with subprime loans, defaulted on their mortgages, which then led to the houses, the decrease in house value and the shift in supply and demand, I guess. Foreclosures. The wave of defaults led to a surge in foreclosures, further depressing home prices and causing significant losses for lenders and investors. Third key event, financial institution failures. Blah, blah, blah. Financial institution failures. Many financial institutions heavily invested in the mortgage-backed securities suffered massive losses. Notable failures include Lehman Brothers and Bear Stearns, which I guess are, or Lehman Brothers is a investment bank, right? And I assume the Bear Stearns are also a similar institution. And number four, credit crunch. The crisis led to a severe credit crunch as banks became unwilling to lend, fearing further losses. Global recession. The financial turmoil spread globally, leading to a deep recession with widespread job losses and economic contraction. Okay, then I have some. Damn, okay, this was a bit longer than I thought. Government response. Bailout is number
Oh,
one.
this is like after the bubble burst, basically.
Yeah. Governments and central banks around the world implemented bailouts for financial institutions to stabilize the financial system. Number two, stimulus packages. Large fiscal stimulus packages were introduced to revive economic growth and restore confidence. Number three, regulatory reforms. The crisis led to significant regulatory reforms aimed at preventing future financial crises, including the Dodd-Frank Act in the United States, which kind of made sure that the regulations were more tightened up, and that I assume that people couldn't get their hands on these subprime mortgages sort of thing as easily or something like that. Yeah. Um,
I mean,
and yeah,
I don't like I have never heard about subprime mortgages anymore. I mean,
no,
are they even? I don't even think they are available anymore, are they? Or is there anything called subprime mortgages anymore? I don't think so.
Giuseppe. I don't
Yeah,
know.
I'm not sure how it is in the US, but I haven't heard about it here in Europe that any country would allow. Yeah, I mean they're obviously looking at your, ability to pay off the loan, like
Yeah,
what other assets do you own and so on, your income and so on. But I mean, not
yeah, it's kind of common sense thing actually, right? To make sure that the people you lend out the money to is capable of paying back the mortgage.
but that's also so interesting because I think they managed to do that since the banks were able to actually sell their risk to other to like the investment banks.
Right, 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 right. Hmm.
So that's why I think they got incentivized.
Yeah,
Like
incentivized. Yeah,
yeah, it worked as a sort of incentive to like, yeah, whatever. I mean, we won't take the risk, so let's just sell as much as we can. Who cares? I mean,
right,
it's
right, right.
not in our hands anymore. So, and I think that was a huge problem. So, yeah.
This is a bit off topic, but didn't wasn't Warren Buffett the one who saved the Lehman Brothers during this crisis?
Maybe, I'm not sure.
I think it was, but because I remember that I watched a documentary where he saved an institution from going under on the Wall Street, and I would assume I would guess it was the Lehman Brother investment bank, but we can double check that.
Yeah.
But all right, I can quickly go through the impacts if you want to.
Yes, sir.
Okay, impact number one: economic downturn. The global economy contracted sharply with millions of jobs lost and widespread economic hardship. Housing market collapse. Home prices plummeted, and many homeowners found themselves with mortgages exceeding the value of their homes. Financial market, or three, financial market turmoil. Uh, stock markets around the world experienced severe declines, and financial institutions faced massive write-downs and losses. Four, long-term recovery. The recovery from the crisis was slow and uneven, with lasting effects on the global economy and financial systems. Yeah, those were kind of uh, the macro or the impact from this crisis on a macro level,
Yeah.
or macro perspective, should I say?
Yeah.
Yeah,
Good.
nice.
I was
So
just looking. Yeah, I
yeah,
was trying to find who saved uh, Lehman Brothers. I don't even know if we're pronouncing the name correctly. Are we?
I think we
Yeah.
are. I've
Lehman.
heard the name before, and I think it's Lehman Brothers. Yeah,
All right, cool. What it says, according to Bloomberg, reports filled with the U.S. Bankruptcy Court Southern District of New York, Manhattan, on September 16 indicated that J.P. Morgan Chase and Company provided Lehman Brothers with a total of 138 billion in Federal Reserve-backed advances.
not bad.
Yeah. Uh, and that's what I could find. Like, that's the first thing that came up.
Right.
Um, but yeah. Yeah.
Oh.
So I don't know. Like generally, what do you think about this whole crisis? What do you think? I don't know. Shall we try to do it like connect it with the other crisis that we have been talking about? Maybe.
We can try.
Yeah.
Uh,
Because it feels like they have so much in common. I mean, with with the just how should I explain it? Because I'm simultaneously thinking about the AI. You know, there are so many people nowadays that say that there is a sort of AI bubble going on. I don't know if you have heard about the company, and I'm not sure how to Nvidia.
Nvidia.
Nvidia, exactly. Yes.
Yeah,
And their stock has just it's just crazy. It has just boomed.
yeah, yeah, yeah.
So many are speculating that there is a new AI bubble going on,
Right.
which will burst. I don't know when, but you know, same. I mean, look at Apple and Google. They also have this um, AI.
Race going on.
Exactly.
Yeah,
So yeah,
sure. Yeah. Somehow, I want to draw some similarities to the Great Depression because
yeah.
after the house market crashed, now when I went through the impacts and like the key events, it sounded like it caused hey, it caused deflation. No, since the banks were like hesitant to borrow, or at least borrow or like yeah, give out money to houses. There were uh, plenty of job losses,
Mm,
result in like a stagnant economy. No, Mm,
yeah. Like a recession.
maybe I'm wrong, but yeah, yeah, recession. Yeah, right. And maybe I'm mixing between the two terms, but yeah, two words.
Yeah. I don't know. It feels like you know. Look at the dot-com bubble. Like after the dot-com bubble, they decreased the interest rates and they made the economy like boom again.
Yeah,
And then came the market, the crash, like the Great Recession, right? The housing market. After they increased the rates again,
yeah,
and then it crashed again. And we have the COVID-19 pandemic. Uh, that also, well, that wasn't because of low interest rate. That depended on other stuff as well. Uh, but I mean, you could see some patterns, right?
yeah,
Um, so we had these low interest rates during 2020, 2021, 2022, and I don't know, then they increased it like crazy because they gave out so many help packages and so on, right? So they pumped a lot of money into the economy,
yeah,
and the inflation just got crazy. And then we had these like very high interest rates, at least here in Europe, and I think it's similar in the US. And now they are starting to lower the interest rates again.
right,
Uh, I think they lowered it in Sweden like 1 or 2 months ago for the first time after I don't know how many years.
right,
Um, so yeah, it's interesting. There are some patterns that you could actually recognize after every every crisis, right?
yeah, yeah,
Um,
yeah,
so yeah, and it feels like a lot of these crises are based on just people's hope, right? Hope on something. Like look at the tulip mania. They were just crazy about those tulips. Um, and then we had the housing market. That also depended a lot of unregulated, just unregulated market sort of,
yeah,
and just too much. how should I call it? Too much freedom with some activities and in some markets. And yeah, same with the dot-com bubble. Crazy investment in every every
company. Yeah,
yeah.
right. I don't. To me, this crisis, the 2007 crisis, the house market crash. I don't know. This one gonna especially strikes me as a crisis that was kind of based upon greed, because I don't know, since um, there there were at least two videos that I watched before we did this episode, began by saying that investors were looking for a new secure investment, and it really seems that way, that they were trying to find a new cash cow to milk, and this
Mm.
was it. And yeah, and it's interesting. It almost seems like when you look through the history, um, there is like a bubble in every industry. Like we had it with the flowers, we had it with the digital companies, we have it with uh, we had it with the house market as well. Um, yeah, yeah, it's interesting. I was looking on Wikipedia one day. Somehow looked again on these financial crises, and in Wikipedia it says that there were like at least a few crises that even happened before the tulip mania. So uh, that's interesting as well to see what those were about. But yeah, that's kind of off topic, but yeah,
I mean, there must have been, right? And there
yeah,
must have been, like, even if they weren't maybe this even if they weren't maybe no, not identified, but maybe considered crisis. I mean, just look at, in maybe in the 1200s, 1300s or so on, when there
yeah.
were so many wars going on. I mean, imagine how hard it must have been for like some countries to just, fight wars,
Hmm.
right? Economically and so on. Of course, I mean, they had a sort of different trading system, indeed, and they didn't have any stocks, I would say. But I mean, I would still call them some kind of crisis, man.
Yeah, yeah,
Or maybe I'm just
yeah. Just tired.
just tired.
Yeah, yeah. But all right. Wait, have you frozen
Yeah.
again? No, dude.
Yeah. Okay, no, no, I'm good. I'm good. I
Oh,
thought I was frozen
uh,
again.
but
But
right. I don't have any more thoughts, to be honest. Um, do you have something you want to end on?
I don't have so many things either. I think we have covered like the most essential. Then there are obviously you could go down in so many rabbit holes,
Yeah.
especially since it's not the easiest topic if you
No.
really dig into it. Um, but yeah, I would say we covered the general points.
Yeah.
All right, everyone. Thank you for listening to today's episode of Philosophy Culture. We hope you enjoyed it and hopefully also got something out of it. which will help you navigate life's spin.
Yeah. And yeah, so this is actually the last episode in the financial history season. And next episode, next season is going to be purely about history. We'll see what topic me and Costin come up with, but yeah, it's going to be fun. And other than that, comment down below what you thought about this financial history season. If you liked it, and maybe we do another one. And yeah, yeah, yeah. See you next time. Yeah.
Adios.
Mm, 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 mm.
Kiki.